Welcome back. In our last session we completed the income statement, and in this session we're going to do the statement of owner's equity and the balance sheets. Remember, the first item that's presented on the statement of owner's equity is the balance of the owner's capital account at the beginning of the period. And if we look at the statement of owner's equity for Net Solutions, which is the business started by Chris Clark, we know that he started on November the 1st. And so on November the 1st, he actually had a beginning capital balance of 0, and that's what's shown after we list our headings. And then we show that he made an investment on November the 1st of $25,000. We know from our income statement that he had a $7,105 profit for those 2 months, which gave him total increases in his capital of $32,105. But then Chris took out $2,000 a month for November and December for a total of $4,000 in withdrawals. And when we subtract that, we get $28,105 net increase in his owner's equity for the period. And we add that to that 0 beginning balance, and we have a ending balance of $28,105. And we know that ending capital balance gets transferred over to the balance sheet. Now we're going to take a look at exercise 4-3, and this deals with a guy named Zach Gaddis, and he owns and operates Gaddis Employment Services. And on January the 1st, 2009, he had a capital balance of $186,000, and then during the year he invested $40,000 and withdrew $25,000, and his net income for the year ended December 31st, 2007 was $18,750. And if we take that information and prepare a statement of owner's equity, it can look like this. Now this format is a little different than what we've been showing, and this is fine. There's different formats that you can use, but this one shows his, of course, the headings at the top, and then it shows his beginning balance of $186,000. And then this one, they add the additional investments of $40,000 for the year and come up with $226,000. And then they take the withdrawals and subtract since the net income was less than the withdrawals, they subtract the net income of $18,750 from the withdrawals of $25,000, and they actually get a net decrease or decrease in the owner's equity of $6,250. And when we subtract that from the $226,000, we get an ending capital balance on December the 31st. And I think this is a little faux pas, but it says 2009. I think on the prior slide it said 2007. But anyway, we get an ending capital balance of $219,750. And now we're going to talk about our balance sheet. And up to this point, we've just talked about a normal balance sheet, and we know that it's prepared either directly from the balance sheet columns of the 10-column sheet or from the adjusted trial balance columns of the spreadsheet. And like I said, up to this point we've just talked about just a normal balance sheet, but most businesses use what's called a classified balance sheet. And a classified balance sheet takes our accounts and breaks them into subsections. We have a subsection for current assets, we have a subsection for plant, property, and equipment, and then we have a subset section for current liabilities and another section for long-term liabilities. Our current assets are assets that are either expected to be converted into cash, sold, or used within 1 year or less, and through normal business operations. And our examples of that is cash, accounts receivable, and supplies. If we have receivables that are not paid within that normal 30 days, most of the time these will be documented as notes receivable. And a notes receivable are written promises by the customer to pay the amount of the note and possibly interest at an agreed rate. And this usually comes about when a customer can't pay their accounts receivable within the 30 days. We'll ask them to sign this note, and so they're they're not disputing what they owe us. Remember, you can always dispute what's on an invoice, but if you signed a note, you're saying, okay, I understand I do owe you this money, and I agree to pay it, and maybe even pay interest on it. And then our plant, property, and equipment section, or fixed assets section of our balance sheet, includes assets that depreciate over a period of time. Remember, the only exception to that is land. Land is never depreciated. But our equipment, our machinery, and our buildings all lose value as they get older. And we recognize this in our income statement with an expense called depreciation expense. And when we make that journal entry to adjust for the depreciation expense, we debit depreciation expense and then credit a contra asset account called accumulated depreciation. And a contra asset just means an offset asset, an offset account. So if I had a piece of equipment that cost $2,000, it would always stay on my books at $2,000. If I had fully depreciated it, I would have accumulated depreciation for that equipment for $2,000, and I would have a zero book value. So we can always take our total amount of our assets, subtract the accumulated depreciation, and we'll know the book value of our assets. Our liabilities that are due within a short period, usually 1 year or less, are said to be current liabilities, and those include our accounts payable, our wages payable, our interest payable, and any unearned fees that where our clients have prepaid us fees. Remember, until we earn that, it's a liability to us, and it's called unearned fees account. Liabilities that are not due for a long time, usually for more than 1 year, are called long-term liabilities, and those include notes payable, mortgages payable, or mortgage payable, and bonds payable. Now, our notes payable and mortgage payable can have current portions, and they would be reported in the current section of our liabilities. And then we have our owner's equity, and remember, the owner's equity is owner's right to the assets of the business, and it's added to the liabilities, and we know it must equal the liabilities, and owner's equity must equal our total assets, going back to our accounting equation. Assets equal liabilities plus owner's equity. If we do our balance sheet for net solutions, remember, balance sheets always just get a date on there. So we have Net Solutions balance sheet, December 31st, 2009. And this is in the account form, which means we have our assets listed on the left and our liabilities and owner's equity listed on the right. So my total assets come up to $29,495. And then if I total up my liabilities and my owner's equity, I get $29,495. Now we're going to take a look at another exercise, example exercise, and this is 4-4, which is on page 149 in your book, and it gives us it asks us to state our accounts, whether they're current assets, plant, property, and equipment, current liability, or long-term liability, or owner's equity. And we know that the capital is what? That would be in our owner's equity section of the balance sheet. Jason Corbin Capital. Notes receivable says due within 6 months, so that would be in our current assets section. Remember, if it's due within 1 year or less, it would be in a current asset. Notes payable due in 2011. That's more than a year from now, so that would be a long-term liability. Now, it may have a current portion, and if it did, we would show that in our current liabilities. Land, remember, is plants, property, and equipment, so it would be in that section. Cash is a current asset. Unearned rent, that would normally, people are not going to pay you more than a year's rent or in advance, so unearned rent would be a current liability until that rent's earned. Accumulated depreciation would be in the plant, property, and equipment offset account, and then accounts payable would be in our current liabilities account. And there's your solutions, and we're going to stop at this point, and then we'll pick back up and talk about doing our closing entries in the next session. Thank you, and again, have a great day.